Good evening, and welcome to the December Self-Made Super Fund Club mentoring webinar, which should be the last of the year. Just for those of you that don't know who I am, my name's Justin Beaton. I'm the Managing Director and founder of the SMSF Club. So before we move to our keynote speaker for tonight's presentation, just want to cover the important information, and that is that the SMSF Club provide what's called general advice. That is, that we haven't taken into consideration your individual personal investment circumstances. The reason that for the majority of clients at least are under a general advice model is that, look, I think the self-managed super fund sector has been designed that self-managed super fund trustees are the ones responsible for making investment decisions. When you look at the main reason why people set up a self-managed super fund is generally to control the investment decisions themselves, which is why we decided to, I suppose, predominantly focus on a general advice framework. We have over the last 12 months, though, moved to a personal advice model. That is, we've seen that a lot of investors, while they set up a self-managed super fund to control the investment decisions, they do need their hand held and require advice around risk management, investment diversification, insurances, contributions advice, which are all components of running a self-managed super fund. So have improved the service offering to our clients. So if you'd like to take us up on the personal advice model, just give us a call or speak to your self-managed super fund financial advisor. However, while that is the case, tonight's presentation is general by nature. It's actually no advice. We're going to be talking about one of the main asset classes that a lot of the SMSF clients have decided to invest a portion of their super money in, and that is property. So look, this presentation, it shouldn't be regarded as advice or recommendation. If anyone wants to speak to either Sam Saggers, the keynote speaker, about property afterwards, or myself on the personal advice model, then by all means, give us a call and we can go through that at a later date. Now, look, I'll transfer straight over to our keynote speaker. Look, Sam Saggers, many of you may have known, he needs no introduction. He's a professional investor and been an investor himself as an individual in the property real estate game for many decades. He's the CEO, one of our great business partners, Positive Real Estate, who have in their own right educated, I think it's over 4,000 or 5,000 individual Australian investors on making that investment into property. So I'm going to pass over to Sam. He's called upon by many magazines, many news channels to provide an update on the property market. So Sam's a good friend and a bit of a business mentor for me. So I'll pass over to Sam, who can give you around the grounds what's happening in the Australian property market, where there's opportunities, maybe a few places to avoid, and a bit of an update on the finance market for self-managed super funds will follow. So over to you, Sam.
Yeah, great. Thanks, Justin. Can you see my slide deck? I've just changed the presenter to myself. Is that in view for you?
Yes, it is. Thank you.
Perfect. Well, welcome everybody to tonight's SMSF mentoring. My name is Sam Saggers. Many of you may know me from, I guess, Positive Real Estate. I've also authored a few books on residential property investment, and tonight really glad to be helping Justin really crack the code on property market of today. Of course, very interesting today. Interest rates on hold again. Reserve Bank of Australia didn't move interest rates. We're in a very low rate real estate market. In fact, the lowest rate in the history of Australia. We live in a time where there's really challenging growth in the economy, and so real estate, of course, is one of those foundational wealth investment products, and for the most part driven by low rates. We've seen really exciting capital growth in our major capital cities. In particular, over the last 4 or 5 years, Sydney has been a standout real estate market. So you've probably heard a lot of information being touted about. Obviously, finance is one of those things that's a little difficult at the moment. The big banks have sort of clamped down on foreign investment. They've clamped down on too much investment to mum and dad property investors. What they've done is typically lowered LVRs to around sort of 80 to 90%, from as high as 98% out there at some point in the not so recent history of lending. So we're going through a lending cycle probably for the next 2 to 3 years, which is going to be a little bit more tough. And then what happens with lending cycles, they tend to get a little bit easier. So it's kind of like a seesaw effect. At the moment, one could say the fat guy's on the seesaw, dropping the interest rates or LVRs at the moment, which is a little bit annoying for us property investors. But we have seen a lot of foreign investors be chased out of the real estate market, and that's probably a good thing. There was definitely a period there where lots and lots of overseas investors were pouring into the country. We have seen an Australian property market, by in general terms, where there's been an oversupply, lots of construction. Of course, developers and government cashing in on the low interest rates, doing their best to supply Australia with property. And Australia needs a lot of supply of property because it is a fast-growing country. In fact, we need a new property every 3 minutes and 55 seconds. Very difficult for the production of that to occur. So no wonder in a low-rate market, we've seen many people buy real estate. Sales volumes have been very, very high across our capital cities. In fact, today, Australian real estate is the major asset class for wealth amongst Australian citizens. Of course, the 4 major primary, I guess, investment classes, from super to Australian listed stocks and commercial real estate. The residential market is really one of those foundations in Australia which everyone is doing their best to make sure is safe and functional. And you see that from low rates from the Reserve Bank to government influencing real estate markets by often creating grants or waivers in stamp duty. So everyone has a vested interest in real estate from the top down, hence making it one of the best asset classes going around. Obviously, voters live in houses, so they like to make sure that the housing market is pretty safe and secure for the most part, which of course is why I love it as a long-term wealth creation vehicle, because really big banks, government, everyone's involved to keep it fluid and going. But we have seen a real bias towards Sydney and Melbourne over the last really 4 years, where in particular those markets have grown exponentially. Standout, of course, has been Sydney, which has virtually doubled in value in such a short period of time. And other markets really have travelled fairly well, flatlined for a couple of years now. You're starting to see a big gap between Sydney and Melbourne, and for example, the next 2 big cities, Brisbane and Perth. Of course, Sydney's apartment market and housing market has really gone up in value a lot. Melbourne's housing market is certainly grown, and that's been correlated by its apartment market. But you will see in the later slides that even though Melbourne has grown, it's still 100% cheaper than Sydney, which is quite astronomical, telling us there's still opportunity in the Melbourne market. And for other markets, we're seeing some encouraging signs of activity from jobs growth data to tell us, well, where is the next market movement going to come? And by all accounts, according to job data, that looks like Brisbane is going to get a little bit of a surge, which is fantastic. We have seen a supply slowdown, which is great, over and above, obviously going through a period of very high production of properties, everyone capitalizing in on the low rates. The low rates have caused a construction boom in Australia. And of course, what that has done with the low rates, we've seen a dropping in rental returns. So often what you find is the yield curve follows the interest rate curve. And as the interest rate curve has essentially bottomed out, you're seeing rents as well bottom out. And a lot of that to do is now with dwellings reaching their zenith of supply and going back to a normal production period, which is great. So what we may see over the next course of the next 3 years is certainly some rental growth, which is great. Obviously, property has both capital growth and obviously a yield, which makes it an interesting investment class. Challenges today, lending constraints mean for the most part 20% deposits, or quite often principal and interest loans will be approved at 90%. Obviously outside superannuation, inside superannuation, lending can be like 40 to 50% as deposits needed to get a loan approval. Sydney housing is yielding very low, only around 3%, but bear in mind our mortgage costs are sitting at around 4% for owner occupiers and 5% for investors, 6% for super investors. So medium house price of Sydney is now over $1 million, which is making it a very expensive world city. Of course, it's a beautiful city, lots to offer, lots of jobs. It's a growing city today, 5 million people into the future, within 3 decades, topping out at 8 million people. But do we want to spend, I guess, $500 a week of our own money holding an investment in Sydney? Because after you get your rental return and you apply your interest rate costs, it's going to cost you a lot to own. And so for most people, whether it be inside or outside of superannuation, don't want to spend $500 a week owning an investment property. Typically, you want to spend maybe $50 a week or $100 a week, but anything more than that, it becomes pretty challenging to hold the asset. Here's a great example. In 2007, the house price was $440,000 and the average wage was in the 50-odd thousands. In 2017, well, the average wage has grown to $80,000, but the actual property values have risen to over $1 million, for example, in Sydney. So it's a 54% increase in wages, but essentially the increase in property costs is much, much more. Simply wages haven't kept up with the property values, particularly in our major cities. What that is doing today is making, in Sydney in particular, economic refugees who are now looking to move to Melbourne or move to Brisbane. We're seeing some great data into those two cities. Just yesterday, I was in a cab and the cab driver was selling his property in Sydney. He'd bought a house and land package in Sydney and watched it grow handsomely in value. He was taking the profit from selling his family home in Liverpool, which was a house and land package, and he was moving to drive a cab in Melbourne, buying a brand new house and land package in Melbourne, but this time not using debt, using cash to pay for it outright. Obviously, these type of trends are happening because a lot of people in Sydney now are asking themselves, where should they migrate their money to? Why should someone migrate their money? Well, you diversify risk. Land tax is a lot easier if you spread your money around. Obviously, chasing a better return is important when it comes to property. Again, returns relate to how much it costs you to own real estate. And really, outside of Sydney, both Melbourne and Brisbane probably represent the best value opportunities going around. We've seen Newcastle follow the Sydney trend and become quite an expensive city. I know many of the super SMSF club buyers bought in Newcastle, which is great. We've seen some great capital growth, but we've also now seen the rental yield drop to around 4.5% in Newcastle, but we've seen capital growth of over 20%. So probably the best value lying around is still our other two major capital cities on the eastern seaboard, being Melbourne and Brisbane. When we look for investment, there are some fundamentals, and probably the biggest fundamental is a diverse economy and a big population. Diversity of people and jobs safeguards real estate investments. The more people, the more jobs, the more different types of variation in employment, the easier and less risk property carries. Of course, you don't want to use your superannuation or just your own money to invest in a small one-horse town. And of course, if economic rationale changes in those micro marketplaces, well, of course, your investment can go down the gurgler. Big cities, they have the demographics, infrastructure, population, they've got good rental pressure, they've got great employment, and of course, there is always a seesawing effect of supply and demand in big cities. Some years more supply, some years more demand. If we look, for example, at the detached housing heat map, we can see Sydney now, for the most part, is well over $1 million. There's a lot of red in that graph. We can see, however, Melbourne and Brisbane have more opportunities within a geographical sensible distance to the CBD centre, to the proper areas of economic foundation. Obviously, big jobs in the city, and of course, Brisbane and Melbourne are, without question, areas where you can look even at detached housing within super today. Many big publicly listed companies, for example, are doing off the plan houses in Melbourne and Brisbane. So it means you can diversify even into detached housing today. Obviously, when it comes to using a superannuation system, you cannot do a two-part contract, being a construction and a build. So today, many publicly listed companies are offering one-part builds, which are fantastic. But you can see, obviously, the value proposition is in Brisbane and Melbourne. In the 2011 census, there were 21.5 million people in Australia. Huge growth in just literally 6 years. We've reached 24.6 million people. It's a fantastic number. And without question, Australia is well on its track to reach the 2051 target of 40 million people. Of course, more people in the country, more taxes that can be created, more infrastructure, things like that. But because we are a giant landscape and a relatively worldwide small population, it really gives us some indication as to where we should be investing, because for the Australian government, with all of that tax revenue, it's really easier to prop up our big cities than expand into new territories as a nation. You're seeing that with the population growth statistics. Our capitals have grown by 10.5% per annum, whereas the rest of Australia, roughly half of that. Remember, those people with their jobs, with their tax revenue coming into the cities creates a heartbeat for those cities, and of course reassures people in those bigger major metropolises that their investments are safe into the future. Interesting enough, from a population increase input, there's only two places in Australia that get both net overseas migration uplift and net interstate migration uplift. The two locations are Queensland and Victoria. To be really more specific, Brisbane and Melbourne. They're getting local migrants, people from, for example, Sydney, wanting to go and live in those areas because it's economically easier. But they're also attracting skilled labour from overseas into Melbourne, into Brisbane, and really get the tick of foundational population growth. Of course, that population growth absorbs the real estate being produced in that marketplace and creates more and more pressure, which is fantastic, what we want to see. By way of explanation, Melbourne last year grew by 109,000 people. Hobart grew by 1,400 people. It's a big difference when we look at the boiled down figures. 1,400 people or 109,000 people. We can see where Australia is putting its economic workforce, and Melbourne is fast on track to become Australia's biggest city. But we can see there is a difference in median selling price today between the big major capital cities. In fact, what's interesting is today Sydney is literally so much more expensive than just about every other capital city. It's 32% more expensive than Melbourne. It's 100% more expensive than Adelaide, 79% more expensive than Brisbane. For example, Brisbane in 2007, Brisbane and Sydney were 7% apart in value. Today, sitting at 79% apart in value. So we can see that maybe investing in Sydney, the horse has bolted, and we need to look at some other marketplaces going around. Probably one thing which has worked in Melbourne and Sydney's favour over the last 3 to 4 years is great jobs growth data. If people feel secure in their job, they spend money. If people feel secure in their job, they buy real estate. And it's probably fair to say in Brisbane, up until recent times, that sentiment has not been there. And you're seeing the latest Queensland figures look very, very encouraging. In fact, you're seeing that Queensland now has the highest job growth data. The green line is coming into Queensland. What that tells us is sentiment is improving. And with that sentiment, places like Brisbane, which essentially has all the jobs in Queensland, there's essentially 1.2 million jobs in Brisbane alone. The next biggest city, the Gold Coast, has something like 180,000 jobs, 1.2 million in Brisbane alone. The jobs data is what we are following. We can see that, in fact, Victoria and New South Wales are leveling off, but if you look at the high of the yellow, you can see it correlates to capital growth. Now we're seeing potentially Brisbane will economically move ahead because people feel more certain about their career. And if they're more certain about their career, they're going to invest in owner-occupier property, which drives the real estate marketplace. Some key facts on Brisbane, because I know it is one place which is pretty popular to invest. Big infrastructure spend up there, lots of jobs forecast, big population shift into Brisbane Metro, which is the largest LGA of Brisbane. You've got literally infrastructure, spending, jobs growth, wage growth. All of that is driving the Brisbane or Southeast Queensland economy. And for the first time in a long time, the population figures and the job figures are looking very, very, very good. Match that with a very affordable marketplace. All of a sudden, you're seeing a lot more sales volumes come into that marketplace, which is fantastic. When it comes to long-term jobs growth, there's 3 players in Australian real estate: New South Wales, Victoria, and Queensland. Those big marketplaces long-term are, without question, of course, Sydney, Melbourne, and Brisbane, where you should own real estate if you are a property investor. Own a property in Sydney, own a property in Melbourne, own a property in Brisbane, because the jobs are in those areas, which is fantastic. We are seeing, obviously, divergence in growth performances between houses and units. We are seeing that houses, obviously, have been the market leader. They're usually a lead indicator in growth, and apartments tend to follow. But the cool thing is many publicly listed companies now are doing off-the-plan houses, which means as a superannuation buyer, for the first time in a long time, you can buy freestanding detached homes as an investor from superannuation. So really, to sum up, I think we need to follow the 3 commandments of real estate, and just a little tip for everyone. Buy a good property, good finishes, good design, great amenity. Choose a great area. You can do what you ever want to in real estate. You can renovate it, flip it. You can just do about anything you want to it, but you can never change its location. Location is a real key driver when it comes to real estate growth. And of course, have a look at the different marketplaces. Sometimes it's better to buy in a market flat, which hasn't had growth, because really the upside is capital growth into the future. Conversely, sometimes it is good to jump on the growth bandwagon as the market soars, because you do get faster economic uplift. Today, probably the fastest economic uplift is in Melbourne, but the biggest growth, I guess, variation is in Brisbane. So that's really my tip today. If you want some longer tail growth, look at Brisbane. If you want some instant growth, look at Melbourne. But probably time to give up on Sydney and move to these other foundational marketplaces. So that's it from me today. Short and sharp, and I hope that was interesting and you got some insights into property. I'm going to put Justin back on and he can start to share his screen, and I can stick around for another 5 or 10 minutes. And yeah, hopefully you enjoyed tonight's presentation, and Justin has some good insights into that.
Thank you, Sam. What we might do, just conscious of your time, is pass over to some questions. I can't see any questions in there just yet, but one of your comments, I have a property in Newcastle which is held in my self-managed super fund. You mentioned before that rental yield has depreciated in value or gone down a little. Can't remember your exact comments. Is that because the capital growth has been so strong over the last 3 years? So the actual dollar rental returns have stayed constant.
Yeah, so because Newcastle has been heavily undersupplied, obviously anyone who knows Newcastle knows that essentially the biggest challenge in Newcastle is supplying the market with property, because much of Newcastle was essentially a mine. So underneath the ground in much of Newcastle proper is mine subsidence. So you can't exactly put new buildings on top of that foundation. So Newcastle is one of those unique markets that is really never going to be oversupplied. But really, as a spin-off effect of Sydney's capital growth, many people today have chosen to buy in Newcastle, to live in Newcastle, because it is more affordable. But the average property has risen $150,000. And what that has done is meant that the rents are lower by virtue that property prices are higher. You haven't seen necessarily a drop in rental returns, more an increase in property prices.
Yeah, sure. My specific property, what I bought, a one-bedroom townhouse in Broadmeadow, and what was 295 grand purchase price I bought off the plan through you a few years ago. By the time the thing settled, it was vacant for like 2 days. I've got a priest that was paying $380 a week in rent, and is now paying $400 a week in rent. So by way of a perfect investment, it doesn't get much better than that. I think if we look at valuing it, it would probably be close to the 400 grand mark. So when you look at the yield from my purchase price, the rental yield was probably 6.5. For people buying it now, the rental yield would be more like 4.5. Despite in dollar terms the rental income slightly increasing.
Yeah, that's exactly right. So still, the Brisbane, for example, still has the biggest return per capital city in Australia. It's sitting at close to 4.7%. Sydney is at 3%, much lower. Obviously, that means you're going to pay more to hold the asset. Typically $500 a week, which no one really wants to do after you take in your tax consideration. Brisbane today yielding at 4.7%. Melbourne today, very tight, very tight vacancy rate, sitting at about 1% in most of the professional suburbs. And literally, yeah, rents are on the rise. So pretty exciting. finally the end of supply, and that'll translate into rental returns, which is fantastic.
Yeah, with the second property, which I also sourced through you out of Brisbane, like I think it was a 2-year construction, and over that period, I think it settled mid this year. Over the 2-year construction period, the dollar rental income was less than, I suppose, what would have been considered market returns 2 years prior. And you look at it, I think, fuck, I expected $500 a week. Now I'm getting 470. However, I think what's important for people to consider is that while, yes, the rental income is less than what it was 2 years ago or what was anticipated, over the last 2-3 years, we've also seen the interest rate drop dramatically. So while the rental income is $30 less, from a net cash flow perspective, I'm actually better off where we sit today when you consider the expense, well, main expense of holding property, which is interest. I think that's something that people ignore.
Well, you brought in St. Julian, didn't you?
Yeah, correct. Yeah, that's right.
Yeah. Well, what's interesting, I mean, that property you've owned that for 5 months. It's settled 5 months ago, around that time anyway.
Yeah, it was June.
Yeah, just yesterday, a resale happened in that. I mean, people talk about a sideways Brisbane marketplace, but yesterday, Richardson and Ranch locally there closed on an owner-occupied buying in that complex. The original investor paid $750. It resold for $840. So roughly about $15,000 uplift per month of actual ownership of that investment since settlement. Obviously, that is just an example of choosing a good asset, good flight to quality property. The three kind of rules, good property, good area, and solid marketplace. So it's interesting because the results, for example, in your superannuation with that property is you've now got an $85,000 equity uplift, which is the power of real estate. So if you can get it right, it does pretty well. And we're talking in a real estate market which has really been bashed up a lot by the media because rents have gone from 500 to 470. But you're seeing with the quality assets close to a $100,000 uplift. Now, I actually think that person shouldn't have sold. They were silly selling for only an $80,000 or $90,000 uplift in 5 months. They should have held it for 10 years. But, that some people do that kind of stuff. So, but the good news is, I mean, you're doing really well with your super, mate. So well done.
Yeah, thank you, mate, because the reason that I've been able to invest in those areas is the education that you and the rest of the team at Positive Real Estate have provided to me. I'm not, by any stretch of the imagination, a property expert. However, my success in my self-managed super fund from property is outstanding. So that's courteous of you. But I agree with those three comments. I suppose some of the lessons that I've learned during the period is that you buy quality in a great location and meet the market. I think a few people try to get the $500 a week rather than getting the 470. It sits there vacant for 3 months. That can put a lot of cash flow problems on an individual, or if they buy in their super fund, on their super fund. My view when it comes to especially superannuation is that you've got to buy quality assets and hold them for the long term, because after all, the purpose of superannuation is to provide an income in retirement. So look, good night, Sam. Thank you for joining us. It's always a pleasure to hear you and your words of wisdom.
No worries.
Thank you.
Thank you, everybody. I'll sign off now. Thanks for having me. Thanks, Justin. Have a great rest of your webinar.
Cheers, mate. In addition to those comments, look, right now I'm probably receiving 3 emails a week, or probably more than that, 1 a day, thereabouts, for the latest quick buck scheme, which is asking me questions about cryptocurrency and Bitcoin. Now, I just want to take this opportunity for the few listeners that have stayed around to give you my view on that particular speculative investment when held inside of a self-managed super fund. Now, I'm not a Bitcoin expert. I know very little about cryptocurrency. I know a little bit, but not enough to really have a fundamental view on whether it's going to go up in value or go down. What I do know is it's going to be extremely volatile. What I do know is that it hasn't been around for that long. What I do know is that there's very little regulation governing the industry. And by what I understand is that limited regulation is what attracts the majority of users for Bitcoin. That's what I know. Where it ends up, I'm not too sure. What are the dynamics behind the blockchain technology seems to be outstanding. Whether or not that translates to the long-term viability of cryptocurrency, again, I am uncertain. What I do know is that superannuation is for the sole purpose of providing an income in retirement. I don't believe self-managed super fund money should be speculating in the latest fad or speculative investment. It's designed to hold assets for the long term to eventually pay you an income stream for your latter years. That's what I believe the purpose of superannuation. If you go back throughout history, every time some people have tried to speculate with their superannuation, it puts them that one step backwards in achieving their retirement goals. As an example, some client may want to dip their toe in the water and just put 10 grand in super from a, call it a 200 grand super fund. If they're making 50 grand a year, that's going to be at least 2 years of superannuation contributions to make up for that 10 grand if they did lose it. And it's because of that high risk associated with it. I don't think it's even viable for a very small amount of your capital. That's my belief. I think you should stick to the traditional long-term investments that have a high probability of providing a return, not to have a speculative punt on the latest hot tip. And that's not just for Bitcoin, that's for speculative share investments. It's for speculative property investments, as Sam mentioned before, like buying in small demographic towns with one key employer is going to be high risk. So that's my view on the speculative market. That's my view on superannuation. The property market has changed. Look, I'm not a property expert. When I say the property market has changed within the self-managed super fund framework, what I'm referring to is what has changed is the lending environment. You go back 12 months ago, look, there was many lenders offering 80% LVR loans for a super fund. Now, look, it's very difficult to find even a lender at 70%. 65% seems to be the norm, and even then, the banks have got a high serviceability criteria, a lot higher than where it was 12 months ago. So previously, if you had 200 grand, you could probably buy a 450, 500 grand property. Now it really depends on your personal circumstances, more so than your superannuation balance, where previously it was the other way around. So I encourage you, if you're considering buying property, maybe a second property, if that's what you've done, if you already own property, then it's very important to get a SMSF finance specialist to review your circumstances before you even contemplate purchasing a property. So you really do need to know what your borrowing capacity is. After all, one thing that's going to underpin what you buy in the residential property market is your borrowing capacity. That's the main thing that we've seen changed over the last 18 months. So look, that's it from me for tonight. We'll be sending out an investor update for all of the investments that we've got prior to Christmas, probably in the next few days. So expect that come to your email, and I may do a webinar just to give an update on all of those investments, just as an easy way to be able to address any questions that some of the investors have. For now, look, if we don't have that webinar prior to Christmas, we will have it either January or February. For now, if we do not speak prior to it, have a very safe and enjoyable Christmas, and wishing you all a very prosperous 2018. Can't believe we're already talking about the new year, as it seems like 2017 only commenced just yesterday. So thank you. Good night. Happy investing.